And good morning. My name is Randy Price. We are the Price Group. How about this? The 1st of June, 2023 doesn't seem possible, but this is the first in our continuing effort to provide more information, provide more perspective, provide more insight with what's going on in what looks like to be a crazy time. But this is our monthly market update, again, version 1. We're going to be doing this. It will be an abbreviated, if you will, webinar. We'll have some prepared material. And then if you would like to participate, you can type some questions into the chat box and we'll get to those as we go. So anyway, who are we? A lot of friends, if you will, old friends and some new friends participating today. Family owned and operated group, 45 plus years of experience. Most important thing is we do follow a fiduciary standard, and we are involved primarily with folks that are within 10 years of retirement or are retired, and that is the Price Group specialty. Couple of, if you've been there, we've been very fortunate to have received some accolades from some various groups, and we are certified financial planning specialists and professionals. And anyway, we want to put that to work for you this morning. Perhaps you're not as familiar with our firm, Steward Partners. Steward, from the biblical definition of stewardship. We do operate as a fiduciary. The number of client assets, 24 billion as of the end of the year. We're knocking on the door to 26 billion here toward the middle of the year, not owned by a bank. Raymond James is one of our custodians. We've just actually added 2 new custodians, but for most clients, Raymond James will continue to be their primary custodian. So let's jump right into some of the meat of what we're talking about. Of course, the debt negotiations, the debt ceiling has been on everybody's mind. Obviously, the government can't default. And so that's got to get past. How that looks, how it works. And some of the uncertainty has been around for a couple of weeks. And we think this is kicking the can down the road, but it is what it is. And this will get done. I think the Senate supposedly is going to vote this week, maybe this weekend. So anyway, here we go. If you've been paying any sort of attention, the news and the news cycles and the newsprint have been about the Federal Reserve raising interest rates. The chart on the left shows this is the most aggressive Fed tightening cycle since the 1980s. Obviously, that's been over 40 years. And so for a lot of people that are alive now, they were not alive or investors during the period where interest rates really went high. If you look back in the history books, money market got over 20%. The 10-year treasury was over 15%. And anyway, even though rates are higher, they're certainly not nearly as high as they were back then. You can see the cumulative Fed tightening from 1983, 87, 94, and it's sort of interesting to look at that. Where is the Fed now? For most of us, for many of the experts, and for what the Price Group thinks, we think there's a pause here. I'm not sure this tightening cycle is over. We're not sure when interest rates might be lowered. But for right now, it feels like just sort of take a breath and the status quo. Chart on the right, what does the market think lies ahead? Again, as we look at interest rates, what's so interesting, if you're a little bit of a geek and looking at this morning, the 1-year Treasury bond is 5.16. Okay. The 30-year Treasury bond is 3.84. And so what investors are saying is they do not think that shorter term interest rates are going to stay at this level and they're going to drop down. Usually what you see is interest rates going up as you go out because there's more risk of owning a 30-year bond than there is a 1-year bond. But for the time being, there's a big difference in that. We call that an inverted yield curve, and typically that's a sign that interest rates will go lower over the in the future. So next slide here, we're going to talk about inflation. Obviously, that's been a big item to discuss. As we see there, consumer price index CPI broken up by core and then super core. And looking at that from year 2015 through 2023, thing to look and point out there is inflation stayed relatively benign over that period of time, and then it started much higher. The Federal Reserve told us it was I love that word, transitory for a while, but people on both sides, inflation likely to continue. Yes, we think it does, but we do think it trends lower, and but it's sometimes doesn't make good writing from a TV station, somebody looking for clicks on the internet to talk about things getting more back to normal. So anyway, with that, we do expect a pause, not a pivot, sort of as I pointed out. Equity performance following a final rate hike typically is good. So someone would say, I'm going to sit on the sidelines. I'm not going to invest money till we sort of figure out where things are, where they're going. We're not of that camp at all. Bonds following the final interest rate hike again do not do real poorly or real well. The average yield you can see there on the right hand side for the bonds, the equity performance following the final rate hike on the left. What really surprises equities is when you have some unannounced surprise inflation. The markets do not like surprises, and from a standpoint of that, we've had a lot of talk about the Fed raising rates, and how they again are going to follow the statistics on where they go in the following 12 months. First quarter earnings. It's a different environment for companies. What are the company's three biggest costs? Well, they're people, and their capital and their raw materials typically. And so the cost of money has really gone higher. And if you are buying a car, if you have a credit card, if you are getting a mortgage or whatever, you're well aware of how that has changed with regards to what the Federal Reserve. Corporate America is cutting costs in order to preserve their margins. And the bank earnings suggest that we do have a healthy financial system. And again, in the wake of what we think are isolated, not systemic bank failures. Of course, that made great reporting, but look at the quotes there on your right-hand side. A guy named Jamie Dimon, who runs JP Morgan, and he says, you've already seen things calm down. This crisis is not 2008. It will pass. Of course, 2008 is called the Great Financial Crisis. There was a lot of sand in the, if you will, the gears of the country, and a lot of excesses, et cetera. But banks today are well capitalized. Morgan Stanley, we're not in a banking crisis. Current issues are not remotely comparable to 2008. Goldman Sachs, the worst of the volatility is behind us. The country's largest financial institutions are very healthy. And so from that, we've had several banks. How did the banks get in trouble? Well, they violated sort of what I would call sophomore, junior year finance, where they were borrowing short term and they were investing long term. And when interest rates go up, bond prices go down. It's a seesaw. It's an inverse reaction. And so they were investing longer term to get some higher yields, and it came back to bite them. And that's just not good banking. One of these banks, for certain, had very few people that even had a history of banking on their board. And so we have seen some bank failures. The FDIC and Again, we think these are isolated incidents. The chart on the left there shows the earnings recession being short-lived. The forecasts are for earnings to move higher. You know, the problem with a recession is that the name recession, the word recession, sounds a lot like depression. And so people say, well, what if we go into a recession? Well, let's talk about that just a moment. Recession is 2 straight quarters where the economy shrinks, doesn't grow. So for many recessions, unless the press told you about it, you might not even know about it. It's just those severe recessions that really come with some pain. Recessions typically mean people will lose jobs, and you have seen some job cutting, especially in some of the companies where the margins are being especially squeezed on that, and the cost cutting can preserve margins. You know, it's sort of interesting. I think companies are actually telling people they got to come back to work to earn their paycheck. So, but anyway, we will press on and with regards to that. Next slide, please. So 5 takeaways from this first quarter earnings season here on June 1st. Companies strongly beating analyst estimates. There on the left show the 10-year average, and then that you do have some companies doing that. We think there's a higher bar for companies to continue to make investors happy. The consumer continues to be more discerning. Positive revenue growth is good, but it's all what it's cracked up to be. And there could be an easing in the economic drag from some of the lagging industries. And tech reclaims its status as an earnings standout. Now, here's an interesting statistic, and it's from the first quarter. So you got 5 companies, Apple, Microsoft, Amazon, NVIDIA, and Google, that make up about 20% of the S&P 500 largest stocks. So think about that. 5 companies are 1/5 of the stocks, and so they had fabulous performance for the first quarter. Apple up over 27, Microsoft up over 20, Amazon 21, NVIDIA about 88%, and Google about 17%. So again, you had a very tech-heavy sort of first quarter. For the first quarter, the Dow Jones was up about 1. The S&P outperformed it up about 7.5, but the NASDAQ was up about 17%. So anyway, it's been a very interesting couple of months of the year. Next slide, please. As we go through our prepared material there, we can talk about any questions that you might have. Again, we want to make this very user friendly from a standpoint of what's going on here. So anyway, I'm just looking for questions here. I do not see any questions. No open questions. So anyway, we will continue to do this on a monthly basis. If you do have questions following this and want to email us or call us, Matt Price is a little bit under the weather, so you're stuck with me if you call. But anyway, be happy to. That's the Price Group. Maddie, Tiffany, Randy, Matthew, and Melissa. So without any further ado, we thank you for joining us here for our first of ongoing monthly updates. Again, steady as she goes. We do think stocks will move higher, and it's not time to run for the hills, and the bank failures are not something you'll see a lot of the rest of the year. So hope you had a great Memorial Day weekend. Here we go into summer, and again, thank you for joining us, and we'll be back soon. For the Price Group, I'm Randy Price. Have a great Thursday. Thank you so much.